Good morning and welcome to the Noble Capital Markets Virtual Equity Conference. I'm Joe Gomes, Managing Director and Senior Analyst at Noble Capital. Today I have the pleasure of introducing Global Crossing Airlines, or Global X. Following the presentation, we will have some time for Q&A. Feel free to submit questions using the Submit a Question function. With us today from Global X is Ryan Gopal, President. With that, I'm going to turn it over to the company. The floor is yours, Ryan.
Great. Thank you very much. And I'm sorry for the delay. As an airline, not being on time is kind of a big deal. So I'll jump right into it. Disclaimer, obviously forward-looking information and risk factors, sort of the standard disclaimer. Basically, who are we? Global Crossing is the fastest growing charter airline in North America. We're doing this by setting our industry standard for on-time performance and reliability. Our customer base includes government agencies, tour, travel operators, other airlines, collegiate and professional sports teams, meetings, incentive planners, and logistics companies. We started in August of flying for revenue in August of 2021. Last year, for Q1, our year-over-year revenue was up 67% to 54 million. And our EBITDA, which is a metric used in aviation, it's a non-GAAP measure, was increased year-over-year from almost break-even to 9 million. This market is a $30 billion market in the US on charter flights. Last year, we did 160 million in revenue. We have a market cap of around 30 million. Again, the market size data, US passenger market's $193 billion market. Air freight is 18 billion. Charter market's 31 billion. So we're playing in a $49 billion market. One of the things I want to differentiate ourselves from is what a scheduled carrier, which most people, when they think of an airline, and all the additives and misnomers about airline investing we are not a scheduled carrier. We are what we call an ACMI operator. And there's a pretty distinct difference, and it has to do with risk. When you think about ticket risk for a scheduled carrier, if the seats go unsold, they lose money. For us, we sell the whole plane, so one passenger is as profitable as 150. Fuel costs, they're exposed to variable fuel cost prices as a scheduled carrier. Our costs are passed through to the customer. Crew costs, they're exposed to ticket risk, i.e. if they don't sell enough. Ours, our costs are passed through to the customer. Billing, there's no compensation for delays. For us, passenger pays by the block hour. And then the aircraft requirements. Scheduled carrier requires a new, high-cost aircraft, whereas an ACMI operator can use an older aircraft because we don't fly as much per month, in which case opens up a different market dynamics for us, which kind of aircraft we can use. Who are we today? Our fleet consists of 13 passenger aircraft and 4 freighters, 17 current aircraft, looking to add 3 more by this summer. We've operated over 45,000 block hours. The metric we use to sell to our customers is on a block hour basis, not by seat. We have 150 pilots hired and trained. We have a key government relationship with 8 dedicated aircraft flying over 1,000 hours a month. And we have key industry certifications, which include IOSA, IATA, and the Department of Defense. So a lot of acronyms there, but what those certifications effectively do, it expands our market we can play in. And if you look at where we've flown in the last 24 months, as you can see, it's a spaghetti map of flights all over the place. We go where our customers want us to go. So a lot of times people ask me, hey, where do you fly? Since we don't publish a schedule, we fly where we get paid to go. And these are all the places we got paid to go in the last year. We are growing rapidly. Again, 1 aircraft, 14 million in revenue in 21, 8 aircraft in 22 for 97, 14 aircraft in 23 for 160, targeting 20 for this year by the summer, and then in 35 by 2026. One of the benefits of our platform is once you've established the platform, your ability to kind of grow is just a case of adding more aircraft to your fleet. One of the things we talk about is how do we really describe what we do internally and how do we manage it? And it's really around 3 things. What are you passionate about? What are you going to be the best in the world at? And what is your economic engine? For us, our passion is we kind of have this conversation is we want every flight to be forgettable. And while some people might think that's a weird way to describe it, but if you ask anyone who travels, explain the last 10 flights you remember, 9 of them were bad experiences. What we want people to do is get on, get off, get there on time, and really enjoy their destination, not the journey. And that's really one of our core passions. What we want to be best in the world at is we call operational excellence. When you're operating in the charter space, there is a ton of logistics and planning and coordination that goes on prior to a flight taking off. We want to be the best in the world at that. And I think if we can be the best in the world at that, we differentiate ourselves with our customers, and it really bodes well for us in the long term. And finally, what's our economic engine? We treat each aircraft almost like a store or a restaurant. Each aircraft profit per month, and how do we maximize the profit per month per aircraft, and keep adding aircrafts. So those are kind of the core concept of the way we do it. And that's really kind of our driving force. When we talk about forgettable flights, the best way to have a forgettable flight is to leave on time. And so the way we do this is we rank our pilots every month, and we publish this internally, not externally, as to how the pilots perform, and the top 3 pilots get kind of a gift card. What we really want to do is hold our captains, who are some of the best captains in the industry, accountable for the on-time departure of every flight. And really by highlighting this and focusing on this, you only get results in what you measure. And I think this is one of the things we do internally to help ensure forgettable flights and on-time performance. When you think about who we fly for, it's a pretty broad market base. About 40% of our contracts revenues on long-term contracts. 2/3 of our contracts are blue chip repeat clients, and we have very varying segments. Collegiate sports is a big segment. Concerts, so flying the crews and the stagehands. We fly for other airlines. Avelo, Breeze, TUI are some of the ones where we fly for. On the government side, with Department of Defense, Health and Human Services, Homeland Security, our big customers, cargo, varied. And again, there's a huge broker network that we work with and for as well, to keep all of our planes active every day. When you think about the financials, basically our goal is to continually improve our financial metrics across all areas. Q1, our revenue is 53.8 million, EBITDA of 9.3. We operated 5,200 block hours. And the reason why we talk about block hours is that's how we charge our customers, is based on the number of hours flown. We had 416 hours per aircraft utilization, actual aircraft fleet of 16, and 8.5 million in cash on the balance sheet at the end of the quarter. If you look at our KPIs, we talk about our EBITDA. You see we've had pretty good growth on our EBITDA, especially starting in Q3. We had a dip in Q1 as we were taking on, and you can sort of see that corresponds with the growth in the aircraft equivalents as we took on a number of aircraft in Q1, which we were seeing the benefits of in Q2 for sure, of having the increased fleet at our disposal. When you think about our revenue growth, again, material growth, 14 million to 97 million to 160 million. As we go to grow our fleet, I think you can see a corresponding growth between fleet and revenue, and we've got significant increases to our fleet in 24 and expected growth in 25. The other dynamic you're seeing is once we get to scale, you're sort of seeing the impact of scale on our EBITDA. $20 million last year, $9 million in Q1. And so we expect to see that continue to grow throughout 24 as we get to scale. So again, multiple avenues to drive growth and profitability, expanding this fleet by 40% in 2024, driving increased utilization by emphasizing our high margin ACMI business. Another dynamic that's occurred is our largest competitor did filed for and liquidated in April of 24. That's 350 million of annualized revenue that's back in the market that we're actually out going and getting. Recently signed government contracts to account for nearly 50% of our fleet, providing consistent, predictable, reliable foundation of revenue. We have the opportunity to expand more into Europe. Currently, it's only 5% of revenue, and that's a very large market which we can participate in going forward. And with a recent management change, we eliminated some non-core initiatives, representing about 8 million of cost avoidance in 24, which allows, kind of going back to the hedgehog strategy of focusing our business on our core activity of narrow body charters, and that's sort of seeing the benefit of that going through starting in Q2. So as far as the investment highlights go, we are the fastest growing charter airline in North America. Strong financial profile and balance sheet provides runway for growth as we transition to cash flow positive. We're well positioned to significantly increase market share. We estimate that the current supply shortage of aircraft is going to go on for the next 4 to 5 years, which only serves to create demand for our product, which we're very excited about. And the new management team is committed to profitability. Our goal is to create a sustainably profitable enterprise for the very long term. And we saw the first part of that in Q1, with the increase of EBITDA materially from 600,000 to 9 million. And we're hoping to continue to increase that going forward. And with that, I realize I talked incredibly fast, but that's to make up for the late start. We'll go back to Joe for questions.
Thanks, Ryan. Great, insightful presentation. Let me start off the Q&A. Can you talk a little bit more about the recent change in management and what was behind that?
Yeah, from the board's perspective, the board, it's no secret that our results weren't exactly what the board wanted in the past. They wanted to focus the business on this core narrow body structure, and I've been kind of tasked with going ahead and doing it. So, in so much as, the benefit is I've been here since the beginning, so I've the transition was pretty smooth. And really, it's not as much what are you going to do, what are you going to not do. And so canceling a bunch of the non-core initiatives, focusing the team on what is our core business that generates money and profit is narrow body charters. And that's really been the focus with the management change.
Okay, thanks for that. And you talk about, your goals for adding additional aircraft. Maybe give us a little idea of, what kind of the process, what's the government approvals you need to get additional aircraft onto the fleet, and do you have these aircraft lined up and just waiting for approval, or is this something you get approval first, then you go get the aircraft?
Well, obviously nothing simple. There's two approvals you need to add an aircraft to your op spec, which is the thing that allows you to operate. First, the DOT has to grant you approval up to a certain limit. So we're approved up to 20 aircraft by the DOT. And then each individual aircraft is approved by the FAA to ensure it conforms with your manuals. So when we think of the growth to 20, the next 3 aircraft have been identified. 2 of them are actually painted already. The third one will get painted shortly. The next 6, we have LOIs in place for. The next 5, we have LOIs in place for delivery for the next 12 months. That process will go through. We'll go back to DOT to increase us beyond 20, which is about a 2 to 3 month process. And then FAA is once the aircraft is ready to go on the certificate, you present them a package of information. They review it, approve it, and then once they give you the green light, you can add it to your op specs. And that usually is a 10 to 15 day process. So I think the short answer is the next three are both approved by the DOT and identified and are pending FAA approval, which we're working on. And then the next 5 after that will require DOT and FAA approval, but they're identified.
Okay. Question from the audience. Do you lease your equipment, and who is your lessor?
So we do lease our equipment. As I said, we have 17 aircraft right now. I think there's 12 different lessors that we work with. So we work with a pretty broad group of lessors.
Okay. And then, obviously one of the key elements here is having enough pilots, and maybe you could give us some color on how are you set for pilots given your expansion plans, and how do you retain your pilots?
So we had a big investment in pilot training and pilot recruitment in 23, and that really impacted the results and in anticipation of the growth. Having 150 pilots on the payroll today, that is enough to execute the planned expansion we have now. We are just now starting to relaunch programs, hiring. We have a class in June and July, and we're scheduling another one for August to fuel the growth for the fall. So I think we're in a really good spot for pilots, and we're timing it a bit better. I think we got a little ahead of ourselves last year, which had a negative impact on earnings, and we're kind of getting a little more refined, as we could say, as it relates to the hiring and training of pilots.
Okay. Another one from the audience. Do you publish ASM?
Average seat miles. No, available seat miles. So we don't publish available seat miles, and the reason is because we don't sell by the seat, right? So we sell by the aircraft. So we only sell whole aircraft, and that's a metric that's different from scheduled carriers. We talk about block hours, and really, if you wanted to know ASMs to translate, you take the number. It's not a super good metric because some of our aircraft have less seats. And since we charge the same for 60 seats as 180 seats, ASMs isn't a great metric, but block hours is the better one.
Okay. And you say about 40% of anticipated revenues derive from long-term clients. Kind of what is your goal there in terms of some of these contracts, what percent you want from ongoing contracts versus what you want to do at the market, so to speak?
Yeah, so we have significant repeat business. We look at our US government contracts. That's a program that's been going on for 20 years. We've ramped up from 3 to 8 aircraft. We had 9 operating in July. And so you probably want to get, ideally, we'll get this up to 70-80%, which I think where we'll get to pretty quick. And then it's a case of the growth and how do you kind of add customers. There's always going to be 3 to 4 aircraft worth of work for sale for the month in the month, given the last minute nature of what we do. And that's always great work to go get. But I think as we grow our fleet, we want to grow it on the backs of kind of long-term clients.
Okay. And you mentioned the bankruptcy of a big competitor. And I think you said 350 million of revenues in play. I mean, how much of that is kind of near term? How much of that is more, further out type of revenue that you could go after?
It's all available today.
Okay, great. And you think you can garner a good share of that?
Yes.
Awesome. You also mentioned Department of Homeland Security is a major client, giving some of the ongoing changes in the government on stuff of that nature. How comfortable are you with them being such a large client?
That program has been around for 20 years. Congress just approved, I think in March, as part of the budget, approved a budget for the next 5 years of 3.7 billion to devote to that program. So I feel like that's a pretty good space to be playing.
Okay, and let's talk about the capital structure a little bit, and maybe you can just give it a little more color. Do you have enough capital for your near-term plans, or any thoughts about raising additional capital or funding, either equity or debt? Maybe you can give us a little more color on that.
No, we're not really in a position where we need that. I think where we're at with our cash position and where we are with our growth rates, the investments have been made. The money we raised in August was what we needed. And so we're just out executing on the business plan.
Okay. I'm not seeing anything else from the audience, so I think we got ourselves back on time, so to speak. You did a great job. Really appreciate it. Really interesting story. And any last words?
No, I think the last words would be, for people who have been following us for the last couple of years, it's a path to, I call it my path to relevance. And as we get bigger and bigger, we're going to be harder for kind of some of the markets to ignore. And our goal is really to be relevant to some of the institutional investors out there who invest in industrials out there. We think we got a really great story. It's scalable. We're at a really good inflection point as it relates to our financial performance. And we're really excited to let everyone know how we've been doing.
Thank you, Ryan. Great presentation. Look forward to it.
Thanks, Joe.
Bye.